Good afternoon and welcome to our webinar today. Well, we're going to get started in just a bit. I'm Tony Dalton and I have Ryan Michelson and Mark Finney with me. McCarthy & Cox has more than 20 years experience of helping people retire from a number of different companies. And because we're located here in Marysville, we've had the unique opportunity to work with many folks from Honda. And that's the topic of today's webinar, 30 things you need to know before you retire from Honda. This can be a lot of fun. We want it to be interactive. And if with your participation, we're going to test your knowledge and share ours. And again, it's really interactive and very fun. So welcome, and Ryan Michelson will get us started.
Yeah, thanks, Tony. So like he said, I'm Ryan Michelson. I've been with the firm for 13 years and in the industry for 16, and looking forward to sharing some of what we've learned through working with a number of clients and families from Honda over the past years. Let's give you some instructions before we get started here. In order to participate, you'll need to grab your cell phone and you're going to send a text to the number 22333. And the body of the text will just be the word McCarthy & Cox. It's not case sensitive, all one word. So if you can text that word to the number 22333, you'll get a confirmation text back that you've joined Cassandra McDonald's session, and you'll be good to go and you can participate as we move forward. So each of the slides will have a question. We'll give you a few seconds to pick what you think is the best answer, and then we'll talk about which one is actually the best answer and why. So we'll give you a few seconds to get logged in here. While we do that, just so you know, the sources for the information that we'll share for you today are listed here. Most of it comes straight from Honda, and it's an evolving thing as we go. As I mentioned, we've been working with Honda retirees for quite some time now, and as I'm sure you're aware, many things have changed on that landscape over the years in terms of pension, in terms of medical, and so forth. So we stay up to date on all that stuff because we work with so many Honda clients. Then also we have the College for Financial Planning, the Financial Planning Association, and the CFP Board of Standards have provided the info for some of these slides as well. All right, so hopefully you've had a chance to get that text in, and we'll reset the numbers here real quick. We were doing a test prior to starting the webinar here. So, okay, that didn't give anything away, thankfully. So the first question is this: at what age is normal retirement in the world of Honda with full pension benefits? In other words, no reduction from an official standpoint. Is it A, age 65, regardless of years of service? Is it B, age 62 with 10 years of service? Or is it C, both of those? We'll give you just a few seconds, maybe 10, 15 seconds to respond. Then we'll talk about what the correct answer is. So looks like we've got some varying opinions here. Taken straight out of the handbook, the correct answer is actually C. So both of the above qualify you to retire from Honda with full pension benefits. That means no reduction based on age. Okay, if interest rates have gone up, what are likely the best months to retire if you're considering a pension lump sum? So you have a lot of different options on your pension, which way you can take it. But if you're looking at that lump sum, which many people are, if interest rates have gone up, what are the best months that you should consider retiring? All right, it looks like a couple of you have gotten this correct. In our view, the best answer would be A, so January, February, or March. In this particular point in time, looking ahead to 2023, that is going to be the scenario. Market interest rates, as you probably know, have come up significantly this year, and interest rates have an impact on your pension. And we'll talk about that more in a little bit. But generally speaking, if you want to get the current set of interest rates, which are more favorable, you'd need to retire sometime before or up to March 1st of 2023. If you go after that, you're going to get next fiscal year's set of interest rates. All right, which of the following are Honda pension options? Which of these are options you'll see when you go to actually begin your pension at retirement? Single life annuity, joint and survivor, certain life period, Social Security level income, lump sum, or all of the above? It's a little bit of a softball. I thought it was a little bit of a softball. Okay, we're getting answers in across the board here, but technically they're all right. But the best answer would be F, all of the above. So when you go to apply for your pension benefit, you'll do this either through the Honda Connect benefit portal, or you'll get a paper packet. That's the more traditional way to go, but either way works fine. But the bottom line is each of these options will become available to you. And the question that you really need to figure out the answer to is which of these options is the most appropriate one for you and your family. Every option on that page is appropriate for someone. The question is which one is appropriate for you, and that's something that we help our clients to determine based on all the factors in their given scenario. Okay, a question on leaving early. This is something maybe some of you have contemplated. I know I've worked with a few people who really wanted to exit Honda before attaining age 55. So the question is, if you quit at 54, okay, which would be resigning, technically not retiring, instead of retiring at 55 or later, it'll cost you about what % of your pension? How much will you give up if you get out of there before 55? 5 to 10%, 30 to 40, 50 to 60, or hey, it doesn't make much difference. Maybe some of you have run this calculation just out of curiosity. Hey, I wonder how much it hurts me if I just jet. And the correct answer is actually B. So in most cases, it's going to be somewhere in the range of 30 to 40%. We've seen this a few times. One specific case that comes to mind for me is I had a client who wanted to retire on his birthday. And I don't know if it was his error or Honda's error, but he submitted it. And when he got his packet back, it showed a retirement date of the day before his birthday. And the reduction off of what he was supposed to get on his pension was about 35%. So thankfully we caught that before he signed off on anything. We noticed the number was a lot smaller than what we knew it should be, and resubmitted for the actual birthday date. And that's how we found out, the exact amount of that difference, but it is material. So my counsel to you would be, if you're getting close, if you're thinking about it, it's a massive reduction, not just on the pension, but also on some of the other benefits that Honda would provide, specifically healthcare coverage and things like that. That all goes away if you resign instead of retiring. So you really need to think long and hard before you leave prior to 55. Okay, this is a true/false question. Only my spouse can be my pension beneficiary. What do you think? Is that accurate or is it not accurate? True or false? So it is true that your spouse can be your pension beneficiary, but it is not true that only your spouse can be your pension beneficiary. So that is a false. The answer to the question is false. And some of the options, particularly the period certain options or things like that, you can name anyone. And even the joint and survivor. A lot of folks just kind of assume that that's only for a spouse, but it could be a sibling, it could be a parent, it could be a child, it could be a significant other that you're not officially married to. So any of those options are possible. And the major driving force between the single life payment, which is the one that goes for your lifetime only, and a joint and survivor or a period certain or another one of those options, which includes a beneficiary, is what is that person's age relative to yours? Generally speaking, the more years younger than you, your beneficiary is, the more the reduction in the payment that you'll get during your own lifetime. And it just makes sense, right? If you want to put your kid as a beneficiary and they're age 35 and you're 55, the chances of them outliving you by a long time are significant. And so Honda's expecting they're going to have to pay your beneficiary for a while after you're gone, and thus they're going to reduce the amount they're going to pay you for your lifetime. So again, goes back to what is the best option for you in your situation. And there are clients of ours that have chosen literally every one of those options on that page that we looked at earlier. Okay, speaking of retiring early, for Honda associates retiring after 12/31/13, your benefit is reduced by what percentage for each year you retire early? And again, remember, Honda considers 62 sort of normal retirement age. So how much is it reduced for each year you leave early? Okay, so the correct answer, somebody's been looking at the handbook or doing their research, is 2% per year. So if you would leave 3 years before age 62, so at 59, you'd have a 6% reduction in your pension benefit. Now, all of these calculations are based on a formula that spits out a single life annuity calculation. That's the assumed form of payment. Everything else is some form of variation on that. So 2% per year off of your full retirement age number. You may say, well, I don't really care how much of a reduction it is. When I'm 55, I'm hitting the door, which is fine in some cases. Just make sure that if you are going to do that, that you've considered the situation as a whole and not just that one element of, well, Honda says I can leave now and not ding me the 30 or 40%. So I'm going to go. You got to think about healthcare, think about income, think about what you may be doing next after Honda if you're going to work part-time. It's not a decision that happens sort of in a silo. This chart is actually taken right from the Honda handbook, and it shows the percentage of your full pension benefit that you get if you retire at different ages. All right, so we've been talking about the pension options a lot. So when might a lump sum make sense? When might that be a good option? If you have poor health, if your income needs are covered by other sources, you really want to leave money to your heirs, all the above or none of the above? What do you think? Okay, so we're getting some variation on the answers again, but really, in our view, again, working with this pension and a number of pensions over the years, all of the above would be valid options. So if your health is poor and you don't know how long realistically you're likely to live and collect those installment payments, if you went that route, then you may want to take a lump sum and be able to have more flexibility. If your income needs are covered by other sources, for example, I've had some clients who have made more of a lateral move, left Honda and went to work for another employer. In that case, you may not need the stream of income that the pension payments would provide. And so you might choose the lump sum, invest it in hopes of growing it for future use. If you really want to leave money to your heirs, so oftentimes if someone is a single person, or they just really have a high desire to leave as much of what they've worked so hard to earn to the next generation, a lot of times a lump sum option can make sense there. One option that's not on here, it's kind of B, but is, if you have a spouse that's younger than you, that's going to continue to work for a while, that's another case where we've seen people take the lump sum if the spouse continuing to work can provide for the recurring expenses or for a good chunk of those recurring expenses. So there are cases where a lump sum makes sense, but I would also contend that that's not the right answer for every household. We've seen, I think, over the years since the lump sum became an option, which began at the beginning of 2014, that a lot of people are interested in going the lump sum route. And part of our process is really talking about the pros and cons of each of those pension choices, because the lump sum is definitely not right for everybody. There are compelling reasons why it may make sense to take a fixed stream of income over your lifetime. All right, another true false question. So Honda lump sum calculation mistakes frequently occur. True or false? Okay, so there's been some chatter about this out there in the area, and there's been even some folks in our business that have tried to use this this idea as a reason to get people to come to them. But in our experience, which is fairly extensive at this point of working with Honda Associates, I would say that's a false statement. And the reason I say it's false is because of the word frequently. So we have had a couple of cases where something was miscalculated. We were able to catch that, get it rectified, but it's the tiniest minority. It's not frequent. It doesn't happen often. especially now, I think Honda has this process down to a pretty good science. The cases that we've seen that involved a discrepancy are generally where someone worked in different locations over the course of their time with Honda, maybe moved from one plant to another, spent some time overseas or things like that. Those kinds of cases increase the probability that something could go awry. So definitely would want to look into the earnings history that Honda has for you in terms of looking at what they're using to calculate that pension benefit. They give you that opportunity, by the way, before you go to start a pension benefit. So that's something you'd want to double check, especially if you've worked in multiple locations. But to Honda's credit too, the times where we have had an associate impacted by a mistake, they have made it right. They're not out to get you. They're not out to cheat you out of money that you should have or things like that. Again, this is our experience, but they have made it right for our clients, which is great. Okay, this is another thing that we get questions on pretty often. So if you would take the lump sum option on your pension, a private annuity or one that you would do outside of Honda can match Honda pension income amounts on a worst case basis. So guaranteed income for life. Can I just take the lump sum and put it with some insurance company and buy a bigger benefit than what Honda will give me? What do you think about that statement? True or false? So you guys are doing well on this. 75% of you think it's false, and that is the case. So right now, and for as long as we've been doing these seminars, as far as I know, there has not been a time where we could take the lump sum and go to a private company and buy a bigger pension benefit, again, guaranteed for life or guaranteed across 2 lives, than what Honda will provide you through their pension. And I believe the primary reason for that is cost. If you take that money and go to an insurance company with it, well, the insurance company is going to take a cut. They're going to pay us a cut. And so there's many kind of hands in the pie if you go that way. And so Honda's pension is in a separate account with a separate company from Honda's general assets, and the costs to administer that plan and so forth are relatively low. So they're able to pay you out a higher amount than what a private annuity could, that you could derive from a private annuity. So if you're hearing from someone that, hey, let's just take the lump sum and let's just go buy you a benefit on the side, you really want to make sure you read the fine print, make sure that it is for life, see what the gotchas are before you go down a path like that, because it's likely not in your best interest. I won't say it never would be, but it's likely not. Another thing that comes up along this same line, a lot of times we hear someone say something along the lines of, well, this guy over here told me he could guarantee me 7% on my money, or things of that nature. And generally speaking, if somebody's making a statement like that, what they're talking about is an annuity, which isn't inherently bad, but they're talking about a guarantee of future income that they make sound like it's almost like a 7% CD, right? Every year you have the money invested, it grows by 7%. Well, that's not exactly true. With these kinds of annuities, generally speaking, what they're talking about is the amount of income that you could have at some point in the future increases by 7% per year, but it's not a value that you could then walk away with if you chose to liquidate it. It's a value that can only be used to calculate a future stream of income. So sometimes that's a good deal, but a lot of times it's not. And also a lot of times these annuities will commit you or tie up your money for a long period of time. So it could be 7 or 8 or 12 years in some cases. We've seen things like that. So again, just if you're hearing something that kind of seems like maybe it's too good to be true, it's a red flag and something that you should look at more in depth. And so our second bullet there is, contact a fiduciary for a second opinion. We haven't really talked about that term yet today, but basically what that means is just talk to an advisor who is legally obligated to act in their client's best interests. And so that's what we are. There are a number of other good advisors out there that take on that standard in how they deal with their clients. And that person has to tell you if there's a conflict of interest involved in something they're proposing to you, or if there's another option out there that's better than what you're looking at. There's an obligation to disclose that to you. And that's what you want. You want to be a smart shopper, so to speak. You want to get the best deal for you. And someone who's a fiduciary is also going to want you to act in a way that benefits you the most. I think probably more people are aware of this answer now than when we started doing these seminars, but a common misconception. Let me ask the question. If you can take the lump sum from the pension, you forfeit your health benefits. True or false? And I think you all know the answer, right? So it is false. Taking the lump sum on your pension does not do anything to your healthcare benefits. It doesn't change them in any way. It doesn't change your ability to get them, to take dependence on the Honda retiree healthcare with you, or any of that. So again, early on, I think that was more of a common misconception than it is today. Enough people have retired and found that, hey, I took a lump sum and I still get healthcare, that it's become sort of common knowledge. So that's good. I'm glad you all got that one right. Okay, this is a slide referring to the estimate that you can run through Honda Connect if you're looking at retirement, looking at dates and things like that, trying to calculate how much your pension may be worth to you. So it says the online Honda lump sum estimator gives you the total amount of the pension payments you're entitled to. Is that true or false? So the estimator does a pretty good job of giving you all the options. There's one caveat to that, and this would be for folks that back in 2013, 2014, when you had that fork in the road, option 1, option 2 on the pension, right? Continue with the pension was option 1 at a reduced crediting rate, get no further pension credits, and go all 401k from here forward was option 2. Many of you probably kind of remember that. It's been a while now. But bottom line, if you took option 1, you're entitled to, when you retire, as long as you're at least 55, an extra $600 a month on top of your pension payment until you turn age 62. And if you take a lump sum, then there's an additional value on top of your lump sum payment that's added on for the value of those $600 a month payments. So we have a slide here that kind of illustrates that out. This is actually taken from a client projection. No names, of course. But this person's lump sum for the dates that they entered was worth $511,000 and change to them as a one-time payment. And then in addition to that, and this would be just below on that same page, there's an early retirement supplement. So this is the present value of the $600 a month payments that this person would have been entitled to between their retirement and age 62. So that worked out to be another $26,943. So if this person retired on these dates that they entered, they would get the 511 plus the 26 as their total lump sum. And it's just something that we see a lot of people miss. A lot of times we're asking, hey, have you run the calculation? They'll give us the first number and not realize what the second one is. So if you take a lump sum, the early retirement supplement is also a lump sum. If you take a form of monthly payment, like a single life annuity or a joint and survivor, then the early retirement supplement comes out to you at $600 a month, which just gets added onto your basic pension benefit. Okay, last slide for me here. Once you make your pension decision, you've had your exit interview, and 30 days have passed, it's final and can't be changed, even if you remarry or divorce. True or false? Yep, so it is true. So the bottom line here would be, before you go to retire, make sure that you've looked over your entire situation, that you're sure it's a good idea, that you know what your next steps are. And the one point there about remarriage or divorce, if you take a form of payment that includes a beneficiary, and if that beneficiary is your spouse, and hypothetically, if 5 years down the road, you get divorced, well, you cannot change who gets that survivor payment. So just take that for what it's worth. That is an irrevocable decision. And that might be one of those cases where if things are a little rocky, you might want to consider some of the other pension options. I'm kidding, mostly. But now I'm going to kick it over to Mark to take us forward from here.
Okay, thanks, Ryan. We're about at the halfway point. So next question, generally, if interest rates go up, my lump sum pension goes up too. We already gave you this answer, so we'll see who was paying attention. You think that's A, true, or B, false? Yeah, good job, everybody. That one's false. So it's an inverse relationship. And like Ryan said earlier, that is exactly what's happening this year. Through recent events, we've had just about the most aggressive interest rate increasing environment our country's ever been in. And so we're bracing for likely one of the most significant decreases to the lump sum coming April 1st of 2023. And I'm sure lots of people at work are talking about that. Okay, next question, you are required to roll over your 401k when you leave Honda. Do you think that's A, true, or B, false? Okay, good job. That is false. And don't let any so-called advisor try to convince you otherwise. You may want to do that if you're hiring professional help, but there are some really good reasons that a lot of people need to keep some or all of their 401k at Fidelity, at least for a period of time after they leave Honda. And I'll go into some more detail on that in just a moment. So next, once I leave Honda at age 55 or over, what is the youngest age I can access my 401k without penalty? When can you start spending that money to live off of? Is it A, right away at 55, B, 59 and a half, C, 62, or D, 70 and a half? What do you think? And every time we've done this workshop, more people have answered B. These rules are really confusing. That's why we're here to help as many families as we possibly can. 401k rules are very different from IRA rules. An individual retirement account cannot be accessed penalty-free until you're 59 and a half. The 401k has a different set of rules. You can start accessing it penalty-free as young as age 55, as long as you stayed at your company until 55. So that would be the good reason. And we have a fair number of people retire before their age 59 and a half. They really need to keep an adequate amount of money in the 401k at Fidelity for the next couple years or 4.5 years if they left right at 55. Okay, so along the same vein, if taking the lump sum, I am required to roll that to an IRA. Do you think that's A, true, or B, false? Yeah, that's false as well. And don't let a financial advisor try to convince you otherwise on that either. You actually could take the lump sum on your pension and roll it into your 401k and combine everything if you really wanted to. You certainly can roll over to an IRA if you're hiring professional help. And that's what lots of our clients have us do with them, but that is not a requirement. Okay, once you retire, Honda provides a $10,000 life insurance policy. Do you think that's A, true, or B, false? Okay, we stumped some of you on this one. It's false. They actually used to do that. They don't anymore. You all would have the basic life that you don't pay anything for. And some of you may have the what we used to call group universal. It's now called supplemental life. You can buy that out into retirement, and you'll have roughly 30 days after your last day to decide if you want to do that. But Honda doesn't give you a free policy like they used to. Okay, Honda contributes $1,000 to the RRA, which stands for Retiree Reimbursement Account, for every year of service up to 30 years at no cost to the associate. Do you think that's A, true, or B, false? Okay, good job. Yeah, that's a phenomenal benefit. Very, very few companies anymore do anything like this. So people can have up to $30,000 as a really nice head start going into that next adventure to use for healthcare expenses. Next question. Many retirees find the process of setting up health insurance payments and RRA reimbursements to be challenging and frustrating. Do you think that's A, true, or B, false? Yeah, we would agree with you. It's a great benefit, but there's no hand holding when you leave Honda. They're not allowed to help you with any of this. It's a rather confusing, not very user-friendly website in a lot of ways. And so what we do for the families that we work for is we just set all this up for you and try to make it as easy as possible. We get together once a year to make sure we're helping do these claims for things like medical premium and other out-of-pocket expenses, but none of it gets set up for you. And we have had a couple cases where people forgot they had this benefit and perhaps, used a different financial advisor who maybe didn't, know that this was out there either, unfortunately. And they sat on this money for, in a couple cases, years. Well, the good news is you can go back to day one of retirement retroactively to start reimbursing yourself, but it is not something that automatically happens as soon as you leave. Now, here's an interesting question. My spouse must be on my health insurance at the time I retire if we want them on the retiree health plan. Do you think that's A, true, or B, false? That is true, and this is confusing, and unfortunately, people have gotten this wrong and found out the unfortunate news later on. So, the key to understanding this is, and why this comes up. So quite often we'll have a couple where one works at Honda and the other one works somewhere else. Perhaps the Honda associate's going to retire first, and then the other spouse is going to continue to work for a while, and they have access to a good group plan at their employer. Well, then if they're going to retire before Medicare age, which is normally age 65, and they want to come back onto the Honda insurance plan because they don't have any other option, well, the key is that spouse had to have been on the Honda insurance prior to the Honda associate retiring. And the handbook is really black and white on that. And so that's something we really want to talk ahead of time about before retirement with couples who would be impacted by that. Okay, so payments from that RRA medical account are tax-free. Do you think that's A, true, or B, false? It's the gift that keeps on giving. It's actually true. They're completely tax-free. Like I said, a fabulous benefit that most Americans don't have. That up to $30,000 is completely income tax-free. They don't just give you a check for it. Again, it goes into a reimbursement account that you can then set up to get paid back for out-of-pocket expenses, but it's completely income tax-free. And there's a number of examples of here up on the screen of things you can use that reimbursement account. It's nearly every out-of-pocket medical, dental, or vision expense you could imagine. On the right-hand column, there's a few things that it just won't cover, like, non-medically necessary surgeries and things like that, but it actually can even reimburse the premium, the monthly cost of the health insurance. And again, just a terrific benefit. Okay, still on that RRA medical account, does it earn interest so that the longer you wait to use it, the greater it becomes? Do you think that's A, true, or B, false? Yeah, that is false. It's not going to go up. So occasionally we'll have somebody say, well, I'm just going to sit on this and save it for a rainy day when I really need the money. We would argue not to do that, because it's like we're saying, it's not going to earn interest. It's never going to increase. And God forbid something happens to both spouses, this money can't go to any other beneficiary like kids. It would go back to Honda. So use it, don't lose it is our mentality. Now, healthcare benefits, are they guaranteed and protected by ERISA, just like your pension? Do you think that's A, true, or B, false? That is a false statement. We don't have any reason to believe Honda would take the retiree health insurance away or any of these other benefits, but it's not a covered benefit that they have to provide like your pension is. So theoretically, it could go away in the future, although we don't think that that'll be the case. All right, to confuse you even more, you can invest your HSA in cash, stocks, and bonds. Would that be true or false? That would be true. The HSA stands for Health Savings Account. That's completely different and separate from the RRA, the Retiree Reimbursement Account. Some of you have picked this option on your current health insurance, and yeah, you actually can invest that money or part of that money if you want to. It may grow and be a bigger amount later on. There's all these acronyms, so to throw a third one at you, HRA versus HSA both offer the same options. Would that be true or false? Okay, this one would be false. They're different. So every year, we just got back in October, we got through open enrollment again. You got through open enrollment. You have a choice of staying with the health reimbursement versus the health savings option, and they're different. They definitely have different coverages and options there. And on the next screen, oops, sorry. Okay, next question. Once I retire, I am responsible for all of the increases in health insurance costs. Do you think that's A, true, or B, false? Yeah, that's unfortunately true. The premium, the cost of the insurance per month is going to change every year. There's been at least 2 out of the last 5 years where it's gone down, believe it or not. This coming year, it's going up, but it's a pretty insignificant amount. It's a pretty small change, but yeah, that number is going to change every year. Okay, when I retire, Honda provides a loyalty card. Is that A, true, or B, false? I'm sorry to twist the knife on this, but last year that went away, unfortunately. They used to, but this is a false statement. They no longer provide that anymore. Honda no longer provides a spousal Medicare subsidy. Is that A, true, or B, false? Yeah, that one is true, unfortunately. Again, that's a benefit that was taken away last year for the spouse. Now, when you get onto Medicare, you're no longer on the Honda health insurance. Normally that happens at age 65, like I mentioned. Honda will pay into that RRA, that reimbursement account, an amount based off of your years of service. They used to pay that also for the spouse, and they don't anymore. So, but those credits do still exist for the retired associate. Another powerful benefit that virtually no other companies provide. I must complete a paper pension packet. Do you think that's A, true, or B, false? That used to be the case. That's false. This changed at the beginning of 2020. The Honda Connect website got started up, and you can actually complete most, if not all, of the pension election process online if you want to, or you can still call the 866 number and order the traditional paper packet. It's no longer a phone book worth of forms. It's now, they've condensed it a lot. It's about 8 pages that need filled out and returned. If we're working for you, we're doing this entire process with you and for you to ensure accuracy, to take one more thing off of your plate and to get the job done there. Okay, Honda Human Resources is generally able to consider all of your assets and debts and make specific retirement and investment recommendations. Do you think that is A, true, B, false, or C, heck no? And we will accept B or C on this question. Lots of wonderful men and women work in your human resources department, but due to liability reasons, they just cannot give you advice. That's why, families hire us. We will look at all of this and help you make decisions on what's the best choice and everything else. But even if you ask, they're legally not allowed to give you advice and guidance on any of your benefits. They can tell you answers out of the handbook, but they have to stop short there. Okay, and all investment people are legally required to do what? A, disclose all fees and commissions. B, disclose all conflicts of interest. C, put your interests first. D, provide ongoing advice. E, all of the above, or F, none of the above. What do you think? We wish the answer were E, but it's not. Most of our industry is made up of commission-based salespeople. If they're not a fiduciary, they don't have to do any of these things. Like Ryan mentioned, we're fiduciaries. We have to do all of these things. But unfortunately, that's just not most of our industry. And so to wrap things up, if you're gonna consider hiring anybody or any group to help you make money decisions, retirement decisions, pension, 401k decisions, do yourself a favor and identify a person who, like we said, is a fiduciary, will provide comprehensive advice, look at your entire situation, will disclose if there's conflicts of interest, how they get paid, and provide you a report, on the history of the firm and the advisor. And then we're going to end with a couple of frequently asked questions. So, one of the first things that usually comes up, some people want to know, is there a minimum for investments here at McCarthy and Cox? And we would say, no, there's not necessarily a hard minimum, but as a fiduciary, we have to make sure that the value is on your side of the table. And can we do enough to better your situation and provide you, with that ongoing holistic financial planning to make it, worthwhile? And, a lot of the time the answer is yes, but we're the first to say, don't hire us if it doesn't look like, we can help your situation. But, there isn't a hard and fast minimum. And we look at everybody's individual situation, differently. So the second frequently asked question is, are all of your advisors experienced? We like to think so. This is my 17th year doing this. A lot of us have, some tenure, and 6 of us are certified financial planners, CFP. as we discussed at the beginning. And, you can go out and look up, time in the industry if you, to Ryan's point, are shopping around for financial advisors, and that's an important thing to do. Right on our website, we have a quick biography on each of us. We're blessed to, as a company, work for roughly 1,300 families, and quite a few of them, like Ryan mentioned, are retired Honda families. And so, most importantly to you out there on this, on this workshop, we have a lot of intimate knowledge of how your Honda benefits work and the mistakes we've unfortunately heard of people making, and how to not make those and to get it right.
Cassandra, can you go back one? Got 2 more points there real quick. So just wanted to address a couple of the ways that we commonly help the folks that we work with. So I'm just going to highlight a couple of the questions that people ask that we help to answer. So the number one question I think that we get from somebody new just coming in the door is, when can I retire and have that be a good idea? That's basically, to put it in layman's terms, when can I retire and be reasonably certain that I'm going to have the income I need for my lifetime, right? If you're going to pull the trigger and leave your employer, whether it's Honda or somewhere else that you've worked for a while, that's a big decision, right? And we don't take that lightly. There's a lot of elements that go into that. So we want to make sure that we've thoroughly explored all of those elements. And I think you're probably getting that theme right now. We're not just looking at your pension lump sum and how we can invest that, but we're really interested in helping you to craft a plan that will weather virtually any storm that could come up in the future. Because this year's been rough. I mean, the markets have been down. People have seen 401ks and IRAs and everything else, decline in value. And for the clients that we serve, we want to give them a level of certainty that they're still on track, regardless of what the market throws at us. So that's the number one thing, is when can I retire and have a sustainable income for life? In close alignment with that, the second question people ask is, well, I have these various assets. I have a 401k, I have a pension, I have some savings, I may have some investments on the side or what have you. How should I structure those things when I needed income from them? Right? A lot of people are very used to putting money into those vehicles and saving and accumulating over time, but this is a whole new landscape, right? I'm going to stop earning a wage from my employer and I'm going to start to draw down on some of what I've saved. That's a little scary too. So how risky should I be? How conservative should I be? Should I have some in some different buckets or different pots to provide for my short-term needs and then hopefully grow some of the money for down the road? How do I do that? So that's something that we work with our clients to develop an investment plan in alignment with their income plan. The third thing people ask is, well, what risks are out there, right? What things could torpedo the plan that we've created together? That may sound like the lead into some kind of insurance pitch, and it's really not. But there are things that could come up that would derail the very best plans that you've laid out in front of you. So we want to make sure that we have conversations around those risks, right? What happens if somebody passes away prematurely? I thought I was going to live for 30 years in retirement, and now I'm seriously ill. What do I do? How do I make sure my family's provided for? What happens if I go into a nursing home or I need long-term care of some sort? Those kinds of questions come up frequently, and they're real issues, and we want to make sure that we've addressed those and figured out, okay, well, if that happens, this is our plan for dealing with it. It may be some kind of insurance, but it very well may not be. It may be something you do through your estate planning. It may be something that you set some funds aside in your account specifically to cover. There's lots of ways to skin a cat, so to speak. So we want to make sure that we've worked with you to develop a plan to cover those risks. A fourth thing would be, if at some point I'm gone, what happens to my stuff, and how do I make sure that it gets to the people that it's supposed to get to and that my wishes are carried out? Now, full disclosure, we are not attorneys, so we don't create wills or powers of attorney or trusts or things like that as far as the actual instruments, but we talk with our clients daily about some of those issues and raise some things for you to take to your attorney and implement potentially. So that would have to do with beneficiaries, with titling of accounts, with making sure that you have an estate plan. I would say the number one thing that we have to hound our clients about is actually getting with an attorney to get those estate documents together, and then reviewing those things over time to make sure that they're still consistent. Over time, your situation changes, your life changes, your family changes, and also some of the verbiage in those documents can change. And you need to make sure that whatever you have in place is current and still reflects your wishes at the time. And then the last thing I'd say that people ask us most commonly is about taxes, right? I don't want to give the government, the state of Ohio, any more of my money than I have to. And we are on the same page about that, right? We're not here to do anything shady or anything that's illegal or anything like that. But at the same time, we have a tax code. It's been laid out in front of us in black and white, and we want to help you, if you're our client, to maximize the amount of your own money that you get to keep and use. There's no benefit for any of us in giving more to the government than we have to. So let's work within that tax code. Let's be smart about the timing of distributions. Let's look at your tax situation when we're late in a year to see kind of where we're at before the book closes, say on 2022. Those are the kinds of meetings we're having a lot of right now, is tax reviews, and just saying, you know, have we withheld enough for this year? Is there any opportunity to do a distribution at year end in a low tax bracket, or to do a Roth conversion or things like that? So not to get too much into the weeds, but those are some of the questions that we commonly help our clients to address and answer, among many others. The final bullet point on this slide, the question is, how soon do I need to get started? If you're a Honda associate and you're seriously contemplating leaving Honda within the next year, now is the time. You know, we would like to have as much lead time as possible to help craft a plan before the separation event comes up. So, you know, a couple of years is kind of ideal. If you know, well, I'm 55, but I'm probably going to stick around to 57 or 58. You know, that's a good time, 2 years or so, 3 years maybe, before you're going to leave, just so you can get some plans in motion that can actually take effect before you leave. But also, if you're at that point where you feel like you're pretty ready to go, but you just haven't done the final number crunching, you want somebody to verify maybe what you've already kind of laid out, this would be a great time to do that. So with that kind of in mind, if you're in that category where you're approaching retirement, you haven't spoken with us yet, if you contact us, the first person you'll talk to will be Tony Dalton, who kicked this thing off for us today. And Tony will go through just some very basic questions with you. And it's your opportunity too to ask questions of Tony about our firm and how we operate and so forth. And once Tony's kind of done that initial interview with you, if it makes sense, then he'll find a time for you to meet with one of us, one of the advisors. And we'll also give you a list of some of the things that would help us in terms of that first meeting, as far as details, statements, information, to make that time as productive as possible. That really helps us to make sure, doing that initial phone call helps us to make sure that if we're going to meet together and take that time, that it's time well spent, both for you and for us. And so if there's a good fit, we would love to talk to you and love to have a chance to help your family make the transition from working into retirement. So our goal would be create a plan and then review that plan over time with you. And our goal with our clients is to serve them and work with them for many years into the future. It's not a one-time transaction. It's an ongoing relationship. And we want to be a resource for you in that. So I thank you very much for your time today. Appreciate you joining us for this webinar. Hopefully you found it useful. And again, if it's something where you feel like you need to take a next step and actually reach out, we would welcome you to do that. You can contact us at the number listed on this slide. And our contact information is also on our website at mccarthyandcox.com. Thanks very much for joining us and have a great day.